couple of things I want to unpack there. The 21 years, very important. It almost coincides with how long I've been in the business. It's 19 years for me in the business. You've seen a couple of markets.
Yep.
Right? What have you learned within that 21 years that even now with, yes, we had the 2 pauses of interest rates, but we just came out of the most increases in a 12-month period that we've ever seen.
Yep.
8 increases to be exact. We saw values at the peak in the Greater Toronto area anyways. February 2022, kind of March 2022, we saw values drop, yet and I know a lot of investors that still bought, but what have you learned from the past that someone watching right now could be like, okay, I could take that on?
Well, I think one thing that most people who have seen what's happened over the last 12 months, who've been investing for a little while, they'll never pass by another opportunity to lock in low interest money for a long period of time. Right? I can't tell you how many people are on variable rate mortgages because their mortgage broker was telling them, and nothing against mortgage brokers. I have many of them and really good friends of mine and they're excellent at what they do. But they're like, why don't you go a variable rate here? You know, you can go from, instead of 2.1% interest over 5 years fixed, you can go to 1.8%.
Trying to forecast
right? And it's like, okay, if anybody else that's experiencing what we're experiencing right now had the opportunity to lock in money at 2% for 5 years, they would take that all day, every day.
All day.
So I think that's the biggest lesson, right? When those opportunities come up, I think you have to be, you can't be so short-sighted to say, I'm going to save $10,000 here or $10,000 there. It's like, can I lock this in for a long period of time, cheap debt, and watch the market do what the market does. And the other thing too is, for me, it's always been about buying properties that are self-sustainable. So they have to support themselves in up markets, in down markets, in neutral markets, because if you're positive cash flow, you don't have to worry about what's happening in the market. What you have to worry about then is just when you want to sell your property, right? If your cash flow covers all your expenses and you've got a little bit left over after that, doesn't matter what the market's doing.
Is there a number that you look for, Darren, in that sense? Like, is it? It can't just be if it covers necessarily, is what I think that you're trying to say, because what if rates go up if you didn't lock in, or maybe there's some vacancy. So what are you looking at in terms of the actual potential expenses to be covered?
I think that for me, it's always, there has to be at least $200 to $300 per door of positive cash flow. But also, I think the way that people sometimes calculate cash flow is a little bit off, and I think that's why when we're teaching this, it's like, how many people that are like mortgage, property tax, utilities, insurance, anything above that, it's positive cash flow. I'm like, you're missing a few things, right?
A couple of big ones.
You're missing vacancy, right? You're missing repairs and maintenance.
What do you put in for repairs and maintenance?
Minimum 5%.
Okay, so
I would say on a standard property.
Okay.
On a brand new like condo, sure, I'll give you 3% if you want.
Okay.
But 5% is kind of where I run. And same with vacancy, right? 5% is a good starting point.
And do you use 5% even in GTA as well?
Yep.
Okay. Just
Why
be
not?
ultra conservative.
Right? Because here's the reality. That number, that 5%, that means you can have 1 month vacant in a 20-month span, basically. So if you have 1 month of vacancy over every 2 years, that's 5%. So the reality of that is pretty strong, that you're going to have 1 month sit vacant.
Oh, for sure. Just even if you're just
period.
turning over
Exactly.
a tenant, right? Like you're going to go in, you're going to paint, you're going to clean and all that.
Yeah.
One thing I wanted to quickly go back to with your first investment property, where it's always funny. I always speak about someone's horror story that they told another person. And generally it was in their first one, their property, and 98% of the time, it has to do with the tenant.
Yeah.
Okay. And it's usually the tenant didn't pay or they ruined my place.
Yeah.
That story that someone's uncle told them back in 1978 now deters anybody or someone or most people from investing into real estate. It didn't for you. Why?
I think that it was a tough lesson to learn, for sure. So my situation was not paying rent, right? Put somebody in. They were a professional tenant.
Got it.
They knew exactly. They were actually looking for me as much as I was looking for them, right? They were like looking for an inexperienced landlord.
Yeah.
because that didn't know, the rules and regulations. I was a quick study, right? And I figured out very quickly how this person, I needed to get them out of my property. And luckily we did that in a way that they didn't damage anything, or they basically, we lost a month or two of rent.
Okay.
It's not the end of the world, right? But the bounce back after that, and I think this is just my personality in general. It's like, okay, I can either exit and say, forget real estate. It was an awful experience. Or I can learn from that mistake and apply it to the next situation and apply it to the next situation after that. And that was what I did. And I've honestly, since that day, I've never had to evict another single tenant.
So what are you doing up front? I take it like there's something that you're doing, like you have a checklist that you go through before you let the tenant in.
It's all of those things, but I think ultimately what you have to rely on in a lot of ways is your gut instincts on people, right? I think I'm a pretty good judge of character. I've been burned a couple times here and there, but I think ultimately if you're, you can do all the checks and balances, and you still need to check references, and you need to do all those different kinds of things. But ultimately for me, it's been relying on my gut. Now, I don't manage a lot of my properties anymore. I pass that off to my team of people that do it, but I teach them the systems that I use. And a lot of that it comes down to, just checking all of those facts and figures and making sure that they're all there. And then ultimately, what's your worst case scenario? And for me, this is a situation where I generally have a higher quality of tenant because most of my properties are well renovated, they're well taken care of. And so, in general, those people are not the kinds of people that, tend to damage properties and things like that. So you have to look at the tenant demographic that you want to go after, and that'll kind of depict how you're investing.
And obviously you're basing that a lot on the location first, I would think, right? Just maybe a higher net worth kind of population and we're okay.